What are some common mistakes investors make, and how can we use a rules-based approach to avoid them? Welcome back to the Systematic Investing channel. I'm Steven, and I'm not an expert nor am I a financial advisor. These are my opinions based on the research that I've done. I'm lucky to have found such great books to have read and learned from. You can check out my reading list in the description below. So with that said, let's go. The most common investing mistakes happen because we fail to overcome human behavioral bias. An example of this is often people sell stocks quickly after they make a profit but hold on to stocks after they suffer losses. It doesn't make sense to hold on to your losers while selling off your winners. But as humans, we enjoy the feeling of being right when we make money and want to lock in the gains so we don't lose them. On the other hand, we don't want to sell our losers as that would admit our failure. But guess what? We got the medicine. Taking a systematic or rules-based approach stops us from making mistakes that will do harm to our portfolio. Let's look at some common core rules to help us overcome bias. First, we create rules for when to open and close investment positions. A simple example would be to only buy new positions at the first of the month and to close positions after a year of holding them if their returns are trailing the S&P 500. Next, we create rules on how to size a position and when to make adjustments to that position. A simple example would be to size all positions equally and not adjust the weightings until after a year in which you will rebalance your portfolio. Now let's look in more depth at 4 types of behavioral bias and how to overcome them. First, let's talk about ego or overconfidence. I have personally struggled with this one and believe that it is one of the toughest to overcome. You will sometimes think that you have a for sure stock pick and will want to go all in. But hey, maybe you double your money in 1 week from picking stocks. This might lead you to think you can pick winners every time you trade, and maybe you can 10x your money if you trade more often. No matter how smart you think you are, the market will eventually serve you up some humble pie. No one knows the future. So the first counter to ego is to diversify your portfolio. Construct a portfolio with at least 5 to 20 positions you believe in to spread the portfolio risk across multiple investments. Next, we construct rules for managing asset positions. Define your common core rules and limits to how often you add funds to your portfolio. One needs to understand that each asset purchase or sale comes with a cost. Bid-ask spread costs occur no matter if you are using a zero commissions brokerage unless you are using limit orders. The more often you trade, the bigger the drag these additional costs will be on your portfolio. Conservatism is the next type of behavioral bias. We tend to overvalue what we already own and undervalue what we don't own. The sunk cost fallacy describes our tendency to continue with an investment if we already own it, whether or not the current value outweighs the benefit. This bias leads us to choosing our default option. We hold on to our losers because we are afraid to admit our mistakes and also not confident in what to do afterwards. You need to understand that you don't have to make money the same way that you lost it. People also tend to only invest in what they know. This leads to home country bias. We quickly forget that we have a globally connected economy and future market performance will not be exactly like the past. So here's how we beat this bias. First, keep a long-term view when investing and invest globally. The more time you have to invest, the bigger the capacity you have to compound gains. The lack of time to truly evaluate our choices can lead us to rely on our biases, which in this context keeps the status quo. Take your time, research, and make a plan. One should always look at both sides of the coin by researching the pros and cons of an asset. Creating rules for such things as handling bear markets allows us to not freeze when the market drops by more than 10%, but allows us to make an active choice on how to proceed. If we stay ready, we don't have to get ready. In the digital age, attention bias is unyielding. There are so many things trying to grab our attention these days, it can be hard to ignore everything. Humans love a good story. So we need to watch out for the great storytellers as they understand that humans suffer from attention bias. Most investment media sources can be the enemy as they are always trying to sell you something. Here's how we handle attention bias. The simplest step would be just to ignore most investment media. Don't watch investment news. Turn off notifications or uninstall investment apps. Done. I know it's not that easy, but really just keep in mind when you're consuming this media that they're always trying to sell you some narrative. We need to focus on evidence, not the stories. We follow our common core rules, which provide a framework for when we want to add new positions. Investment media also wants you to believe that you can time the market. That ain't happening. But no, on average, there is at least a 10% drawdown in the market every year. Create rules to automate recurring portfolio purchases, which removes the noise. And lastly, we have emotional bias. Controlling emotions can be one of the hardest things to do as investors. Just getting started investing can be one of the biggest hurdles. You put off starting to invest for when you think you're ready, but that day never comes. We read and hear stories about everyone else making huge returns and feel like we're missing out. You take on more risk and borrow money to invest because you feel that the market owes you for the money you lost. So how do we subdue these emotions? Take a guess. With rules. Create rules while you're in a good state of mind, so you don't adjust your portfolio while you're hungry, angry, lonely, or tired, as nothing good will come from it. If you have not started investing, then set aside some time to find a brokerage with low fees and account starting minimums that works for you. And finally, create rules to automate recurring portfolio purchases and limit your access to your investment account. I hope these rules provide you a step in the right direction. Here are my common core rules I have created for my portfolio. My portfolio strategy attempts to maximize diversity and balance risk between different asset classes. Here's how I open and close new investment positions. I only trade once a month and I rebalance once a year if needed. My portfolio holds multiple asset classes, and here's my setup for creating and closing positions. In my equities bucket, new positions must be in a sector with good momentum and not be correlated with the S&P 500. I have capped these holdings at 10. I don't sell any existing positions. For bonds, I use the relative momentum of normal bonds and tips to decide my bond positions. I sell the existing positions when I rotate. I use the ETF bar to represent my gold position and will only replace bar if I find an ETF with a lower expense ratio. I do not sell existing positions. For Bitcoin, I don't hold any Bitcoin directly. Any new positions must be correlated or hold the Grayscale Bitcoin Trust, GBTC. I don't sell any existing positions unless they are no longer correlated or hold the Grayscale Bitcoin Trust. I hold up to 10 positions for at least a year. I use the All Seasons portfolio as my base for my position sizes. I then tilt those positions based on momentum. Check out my previous video for more details. Again, I'm only trading once a month and I rebalance once a year if needed. I set up the original weights for equities using risk parity and cap the higher ETFs at 5%. Any new positions will take their weighting from the S&P 500 ETF up to 5%. Only the S&P 500 ETF is adjusted when new positions are added. For bonds and gold, the size positions are adjusted based on momentum. Bitcoin is not adjusted based on momentum. It will always remain 3% of the total portfolio. What rules have you set up for yourself to help with behavioral bias? Subscribe and share in the comments. Take the next step to minimize emotion and maximize discipline. Cheers.